Bitcoin is falling again. But the real trap may not be Bitcoin itself. The real trap is the emotion investors bring into the market after a long day of red candles, broken confidence, and mixed signals from Wall Street. When price falls far enough, the human brain starts looking for comfort, and that comfort usually sounds like one sentence. Maybe this is finally the dip. But in markets, the most dangerous dip is not the one that looks scary. It is the one that still feels buyable. Right now, the market is giving investors two opposite messages at the same time. On one side, AI is still the dream, still the growth story, still the reason many investors believe the next leg higher has not disappeared. On the other side, chip stocks are shaking, Bitcoin is weak, ETF flows are turning heavy, and the leadership that carried risk assets higher no longer looks invincible. That emotional conflict is exactly where retail investors get trapped, because they are not just analyzing price, they are fighting regret. The fear is not simple fear anymore. If this were pure panic, the decision would be easier because everyone would be running away. But this is more uncomfortable than panic, because investors still remember the last time they hesitated and the market ripped higher without them. So the question in their mind is not just, is this safe? The real question is, what if I wait and tomorrow the bounce starts without me? That is why this moment matters for Bitcoin. Bitcoin is not falling in isolation. It is reacting to the same liquidity pressure that is hitting other risk assets. When ETF flows weaken, when AI stocks lose leadership, and when the market starts questioning whether growth can keep paying for itself, Bitcoin becomes more than a chart. It becomes a stress test for risk appetite, and right now that test does not look clean. At the calm metrics, the key idea is simple. Price is the surface. Liquidity is the message. A falling price can be a discount, but a falling price with weakening flows can be a warning. The trap is thinking that every red candle automatically creates opportunity, when sometimes the red candle is only the first visible sign that money is stepping back. That is why the smartest question is not, how cheap is Bitcoin now? But, is liquidity still willing to defend this market? AI makes the situation even more emotional, because AI is still the story investors want to believe in. Nobody wants to be the person who sells the future too early. But Wall Street is not only asking whether AI is powerful. Wall Street is starting to ask who pays for the infrastructure, who captures the profit, and how long investors can keep pricing perfection. When the market starts asking cost questions instead of dream questions, momentum can change very quickly. This is where the end-of-day investor gets stuck. They look at Bitcoin and see fear, they look at AI and see hope, and they look at their own portfolio and feel pressure to make a decision before the next move happens. That pressure creates bad trades, because the investor is no longer responding to evidence, they are responding to the pain of missing out. And when FOMO mixes with fear, the market does not need to trick you with a big crash. It only needs to offer you a bounce that feels believable. The next signal is not just whether Bitcoin bounces. The more important signal is whether Bitcoin can bounce while ETF flows improve, chip stocks stabilize, and risk appetite returns with real strength. If Bitcoin rises while liquidity keeps leaving, that bounce may only be emotional relief, not confirmation. But if flows improve and leadership returns, then the market may be telling a different story. So the decision tonight is not buy or sell because price moved. The decision is whether the evidence is strong enough to trust the move, or whether the market is only pulling investors back into risk before the real confirmation appears. A calm investor does not need to catch every bounce. A calm investor needs to avoid being forced into emotional decisions. Because in this market, the most expensive mistake may not be missing the dip. It may be buying the dip before liquidity comes back.